Welcome to our video. This video will be categorized in Accounting 1 and 2. Financial Ratios, Part 2. The first category of ratios we will discuss are turnover ratios. The inventory turnover ratio is calculated by dividing cost of goods sold by inventory. This ratio checks the efficiency and shows how quickly a company uses its inventory. The receivables turnover. This is calculated by dividing sales or net credit sales by accounts receivable. This ratio measures how efficiently a company uses its assets. Days sales in receivables is calculated by dividing 365 days by the receivables turnover, which is mentioned above. This essentially tells you how long or the average amount of days that your receivables are staying on the books. Fixed asset turnover. This is calculated by dividing sales by net fixed assets. Lastly, total assets turnover. This is calculated by dividing sales by total assets. This shows the company's ability to use its assets to contribute to sales and/or revenue. Here you will find our financial statements. Now you may be thinking, oh, these look familiar. It's because they are. They're the same financial statements that we've used in prior examples and other videos. We will use our balance sheet and income statement to extract the numbers to evaluate our different ratios. Here are the numbers. So, our receivables turnover is 72.80. This essentially means that either our business operates on a cash basis or we are pretty efficient because it's relatively high. Days sales and receivables is 5.01. So that basically shows us that on average it takes 5 days for any of our receivables to clear the books. Total asset turnover is 8.35. This is pretty low, so as managers, we may want to have a discussion and dig deeper and take a look in the books to figure out how we can become more efficient. The next category of ratios we will discuss are profitability ratios. These ratios basically measure our profit. Profit margin. This is calculated by dividing net income by sales. Return on assets, or ROA. This is calculated by dividing net income by total assets. And lastly, return on equity, or ROE. This is calculated by dividing net income by total equity. Our profit margin essentially measures how much of each dollar is linked to our revenue that we receive. Our return on assets shows how efficiently our assets are contributing to our revenue earned. And lastly, our ROE, return on equity, shows how efficiently equity is being generated in relation to our revenue. Here are our handy-dandy financial statements. Feel free to pause the video or to come back to the video when examining the numbers for the different ratio analysis. And on our income statement, you may see under revenue fees. In this case, we're going to use fees and sales interchangeably because technically we're operating as a specific type of business since we have cost of goods sold. So in this case, it would be sales instead of fees. Here are our numbers. So by looking at our profit margin, as we can see, it's 5.6%, which is extremely low. Our return on assets is approximately 47%, which isn't bad, and our return on equity is 125%. So it appears that our return on equity is the only item where we're operating at maximum or optimal efficiency. So that gets the green light. Our other two items, especially our profit margin, as managers, we would need to actually dig into the numbers and re-strategize and replan to find out ways to increase this. Have any questions? If you have any questions, please leave your comments below this video. We respond to all comments. If you have any suggestions of any subject matter you would like to see, also leave that in the comments below. Stay connected with us via social media. Thanks for watching our video.